As couples embark on the journey of marriage, it's not just hearts that unite, but finances too. Today we explore the financial impact of tying the knot. We're going to look at both the challenges and the benefits that come with saying I do. Let's explore the financial benefits of marriage, and there are many. First and foremost, living together is generally more cost-effective than living apart, and sharing resources allows for a more comfortable financial situation. Another significant advantage is the ability to pool risk. For instance, if you lose your job, but your spouse is still working, it will likely be easier to cope financially than if you were single. The Social Security system also brings forth a financial bonanza for married couples. Claiming spousal benefits and optimizing the timing of benefit withdrawals can significantly enhance financial security for both during retirement. For example, let's say your spouse has earned a much higher salary than you throughout their career. You could claim spousal benefits based on your spouse's earnings record and have a much higher monthly payment from Social Security in your retirement. Now let's talk about the potential pitfalls of marital finances, and this brings us to the infamous marriage tax penalty. In a nutshell, that means that some couples could end up paying higher taxes than the sum of what they would each pay as individuals. You know that lovely phrase often said in marriage vows about the couple becoming greater than the sum of its parts? Well, that can also be true for the couple's taxes. According to the Tax Foundation, prior to the Tax Cuts and Jobs Act of 2017, the marriage penalty was especially pronounced for medium to high income earners and could be up to 12%. That's because the tax brackets for married couples were not twice as wide as the equivalent brackets for singles. For example, back in 2016, if two people each made $90,000 a year, they would be in the 25% bracket as singles, but once they got married, together they were in the 28% bracket. That difference is the infamous tax penalty. The good news is that currently almost all tax brackets for married filers are exactly double those for single filers, except for the top 37% marginal rate. Therefore, the marriage tax penalty at the federal level is generally only felt at very high income levels, namely by single people making over about $600,000 and married people making over about $730,000 combined. So today, that same couple we talked about earlier making $90,000 each, they'd be in the 22% tax bracket whether they stay single or get married. With today's tax brackets, they don't get penalized for getting married. But that doesn't mean the marriage tax penalty is all but gone, as it persists in several credits and deductions. For example, the state and local tax deduction. It's capped at $10,000 for single filers. How much is it for married filing jointly? Exactly the same, $10,000. So by getting married, two singles lose half of their deductions. Furthermore, several states have a marriage penalty built into their tax bracket structure, according to the Tax Foundation. To be fair, there are also tax benefits from being married. For example, spouses who are both US citizens may transfer unlimited amounts to each other during their life without incurring any gift tax. Another example, when a spouse dies, they can leave property of unlimited value to the surviving spouse without incurring any estate tax. This unlimited marital deduction insulates all assets from tax. Bottom line, while there are challenges to navigate in the realm of marital finances, the potential for financial stability, shared resources, and strategic planning can make the journey worthwhile. And if you want more content like this from MarketWatch and the Explainomics playlist, please subscribe and keep checking back for new videos, and we'll see you next time.